I want to start with something that almost never happens in bond markets, a clean experiment.
In late October 2025, Meta went to the corporate bond market and borrowed $30 billion. Part of that was a 30-year bond, and the coupon, the fixed annual interest rate the company promises to pay, was 5.625%.
Then, 7 months later, in early May 2026, Meta went back and did it again. $25 billion this time. Same company, same credit rating, same seniority, meaning the lenders sit in the same place in line if anything goes wrong. Same currency. And again, a 30-year piece.
That second 30-year coupon was 6.3%.
67.5 basis points higher. A basis point is 1/100th of 1%. So that is roughly 2/3 of a percentage point more to borrow the same money for the same length of time from the same market by the same company.
And that is genuinely rare. Normally, when you compare two bonds, you're comparing different issuers or different maturities or different structures, and you cannot cleanly separate what changed. Here, almost everything is held constant.
So the question this episode answers is simple to ask and surprisingly hard to answer. Well, what actually got more expensive? And who else ends up paying for it?
Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research. Welcome to Follow the AI Money on the Working Thesis. I'm Theo.
And I'm Maya. Before anything else, the disclaimer, and we mean it. This series is educational. We analyze capital flows and industry structure. We are not financial advisors. Nothing here is investment advice or a recommendation to buy, sell, or hold anything, and we do not give price targets. We are here to hand you a way of thinking, not a conclusion.
This is the second of a two-part arc we are calling The Financing Web. In its first 7 episodes, this series followed the money down the chain through memory, power, packaging, cooling, and ended on the question of who ultimately pays for all of it.
These two go underneath the chain instead of along it. The previous episode asked who lends the money for the build-out and found that a surprising amount of it sits in structures that never appear as debt on anyone's balance sheet.
This one asks the follow-on question. If all of that borrowing is happening at once, does it cost anybody who has nothing to do with artificial intelligence? And you do not need to have seen the previous episode. Everything here stands on its own.
When you show people that Meta paid 67.5 basis points more, you get one of two explanations, and both are delivered with confidence.
The first is rates went up. The Federal Reserve, the economy, inflation, the whole level of interest rates rose, and Meta got dragged along with everybody else. Nothing specific to artificial intelligence in it at all.
The second is the opposite. The market got scared of artificial intelligence. Lenders looked at the scale of the spending, decided the risk had changed, and charged Meta more for that specifically.
Both are single-cause stories. And the reason this experiment is worth an episode is that you can test them separately with public data.
So let's build the tool that does it. Once you have this, you can run it on any bond you ever look at.
Any corporate borrowing cost splits into 2 pieces. The first is the risk-free rate, what the government pays to borrow for the same length of time. The second is the credit spread, the extra amount a company pays on top because a company can default, and a government borrowing in its own currency is treated as though it will not.
Coupon equals the government rate plus the spread. That is the entire tool, and both halves are public.
So take the first date, the end of October 2025. The U.S. Treasury 30-year yield was 4.65%. Meta's 30-year coupon was 5.625. Subtract, and Meta's implied credit spread was 97.5 basis points.
Now the second date, early May 2026. The Treasury 30-year had risen to 5.02%. Meta's coupon was 6.3, so the implied spread was 128 basis points.
Which gives us the decomposition. The government curve moved 37 basis points. Meta's own credit spread moved 30.5.
Roughly half and half. And that is the first real finding, because it means neither confident story was right. It was not just rates. It was not all AI risk. It was both, in close to equal measure.
One caveat before we go further, because we would rather say it than have you find it. The spread we just calculated and the spread indices we are about to use are not identical measures. They are constructed differently. And 2 dates are not a trend. So we will treat the direction and the rough magnitude as meaningful, and we will not overread the decimal places.
Now, the obvious objection, and it is a good one, maybe all corporate credit got more expensive over those 7 months. If every company's spread widened, then meta widening is weather, not a signal.
So we checked, and this is where it gets interesting, because the answer is a flat no.
These are the ICE Bank of America indices, the standard public measures of corporate credit spreads across the whole market, available from the St. Louis Fed's database. We pulled them for the same 2 dates.
AAA-rated companies, the safest tier, spreads widened 4 basis points. Single A, 4 basis points. Triple B, the lowest investment grade tier, 3 basis points.
And Meta's own rating band, Meta is rated AA-, widened 6 basis points.
6. Against Meta's 30.5.
Then the one that really settles it. High-yield bonds. Companies rated below investment grade, the riskiest part of the corporate market, the part that moves first when investors get nervous, did not widen at all. They tightened by 6 basis points. They got cheaper.
So there is no general risk aversion story available here. If investors had broadly decided the world was riskier, high yield is the last place that would improve.
Which lets us say something precise. Meta repriced by about 5 times its own rating band and about 10 times the broad market. We want to be exact about which comparison we are making because those are 2 different comparisons and both are on the screen.
Here's the version of that finding we think is most striking, and it uses the tightest control we could build.
We took the investment grade index for bonds with 15 or more years to maturity, matched to Meta's actual tenor. Long money against long money, rather than comparing a 30-year bond to a market average full of 5-year paper.
Over the 11 months we have data for, that index traded between 0.88% and 1.12%.
The entire trading range of the long-dated investment-grade bond market over 11 months was 24 basis points. Meta repriced by 30.5 in a single trip to the market.
One company's one bond deal moved more than the whole market moved all year.
And the cleanest way to see it is where Meta sat relative to that index on each date. In October 2025, Meta priced at 97.5 against an index of 94. Essentially at the market, Meta was paying about what long-dated investment-grade credit paid.
By May 2026, it priced at 128 against an index of 97, 31 basis points wide of a market that had barely moved.
Meta went from paying the market rate for long money to paying a premium to it.
And one more thing, which cuts in our favor, so we should say it plainly. This control is conservative. Those indices contain Meta. They also contain Oracle, Alphabet, Microsoft, Amazon, and Broadcom.
The large AI borrowers are inside the benchmark we are comparing them against. So the true move for everything that is not an AI borrower was smaller than 3 basis points, not larger.
This is also the answer to a line you will hear often, that credit spreads are tight, so there is no stress anywhere. That is true in aggregate, and it is exactly what makes the AI-specific widening visible once you look underneath the aggregate.
Now we need to change the measurement window, and we want to flag that clearly, because otherwise the next numbers will not seem to reconcile with the last ones.
Everything so far compared 2 specific bond deals. End of October 2025 against early May 2026. This next number runs from a different starting point, the day the Federal Reserve stopped shrinking its balance sheet.
That was the 1st of December 2025. The Fed had been running what is called quantitative tightening, letting bonds it owned mature without replacing them, which gradually pushes those bonds back out into the market for private investors to hold. On that date, it stopped.
And we want to be precise about this, because there is a claim in wide circulation that quantitative tightening is draining liquidity out of the system right now. It is not. It ended in December 2025.
So here is the measurement. There is a thing called the term premium. The extra yield investors demand purely for holding a long-dated bond instead of rolling over short-term ones. It is the compensation for locking your money up and carrying the risk that rates move against you. The New York Fed publishes an estimate of it.
On the day quantitative tightening ended, the 10-year term premium was 0.48%.
As of mid-August 2026, it was 0.84%.
It nearly doubled, with quantitative tightening switched off.
And you can see what that did to the bond itself. Over the same window, the 10-year Treasury yield went from 4.09% to 4.68, 59 basis points. Term premium accounts for about 36 of them, roughly 60%.
Which tells you where the move came from. When a yield rises because investors expect the central bank to raise rates, that is a changed policy path. When it rises because term premium is rising, that is investors demanding more to hold duration.
This is the second one. And for scale, the 30-year Treasury yield reached about 5.3% in August 2026, its highest since 2007.
So if investors are demanding more to hold long-dated bonds, the natural question is how much long-dated paper is being pushed at them, and by whom?
There is a Federal Reserve paper that sizes exactly this. DeVere, Ramaswamy, and Searles, published by the Federal Reserve Bank of Dallas in February 2026, on how AI debt financing affects duration supply and interest rates.
Their estimate: Wall Street expectations for AI-related investment-grade issuance center on about $300 billion for the year.
But the dollar amount is not really the point. What matters to the bond market is duration, how much interest rate risk all that paper collectively forces investors to absorb. A 30-year bond consumes far more of the market's appetite than a 2-year note of the same size.
So, they converted. $300 billion of AI-related issuance produces as much as $360 billion in 10-year equivalents over the course of 2026.
And here's the comparison that makes it concrete. That is about 1/8 of the duration supply coming from U.S. Treasury issuance.
1/8. Large enough to matter, and small enough that we should be careful about it. And we will come back to exactly that.
The same paper describes 3 separate routes by which this borrowing reaches the interest rate market. The first 2 are fairly intuitive. The third is the reason we wanted to make this episode.
Channel 1 is direct. Companies issue long-dated investment-grade bonds. They borrow long because the assets are long-lived. A data center is not a 2-year proposition. And because the economics do not swing with the business cycle, so borrowers want to lock in a fixed rate. That is straightforward duration supply.
Channel 2 is synthetic. A lot of this build-out is funded by private credit, which typically lends at a floating rate, meaning the interest resets periodically. Borrowers usually do not want that uncertainty against a 20-year asset, so they enter an interest rate swap, an agreement to pay a fixed rate and receive a floating one, which converts the loan's economics to fixed.
The effect on the market is nearly the same as issuing a long bond, even though no long bond exists. The paper estimates this may have added around $50 billion of 10-year equivalents in the fourth quarter of 2025 alone.
And then Channel 3. This one is genuinely underknown, and it runs in the opposite direction from what you would expect.
Banks and insurance companies are regular, heavy issuers of corporate bonds. But when they issue a fixed-rate bond, they very often enter a swap to convert their own obligation back to floating, because their assets and liabilities are structured that way.
And the counterparty on the other side of that swap ends up absorbing fixed-rate interest rate risk. So when a bank issues a bond and swaps back to floating, the net effect is that duration risk gets quietly taken out of the Treasury market and placed with corporate bond investors instead.
Financial issuance has been doing the government bond market a favor, continuously, invisibly, for years.
Now, suppose technology issuance grows and financial issuance shrinks to make room for it, because there is only so much investor appetite. Total corporate issuance could be completely unchanged.
But the swapping back to floating stops, and that quiet support for the Treasury market disappears with it.
That is substitution. The composition of who is borrowing changes the interest rate market even when the total amount of borrowing does not. It is a mechanism that stays invisible right up until it reverses.
At this point, a reasonable person asks an obvious question. If the problem is too much long-dated paper for the market to absorb, why does the government not simply buy some of it back?
It is a fair question, and the useful thing is that it was tested in public very recently.
On the 19th of August 2026, the U.S. Treasury announced it was increasing the size of its long-end buyback operations from $2 billion to at least $4 billion per operation, covering the 10 to 20-year and 20 to 30-year sectors, running from the 9th of September to the 4th of November.
And it is worth being precise about what those buybacks are, because they are widely misunderstood. This program is liquidity support. The Treasury buys back older bonds that have become harder to trade, what the market calls off-the-run paper, and it funds those purchases by issuing new bonds in the same maturity range.
Which makes it broadly duration neutral by design. It changes which bonds exist. It does not change how much duration the market has to hold in total.
And if you have followed the logic of this episode, you can already predict what that implies. If pressure on the long end is a duration supply problem, an operation that leaves total duration unchanged should not durably relieve it.
The 30-year yield fell about 9 basis points on the announcement. Within 2 sessions, it had largely retraced.
Now, we want to be fair about what that does and does not prove. The larger operations had not yet begun. The stated objective was market functioning, not a yield target. And oil prices, inflation data, and global bond yields were all moving over the same few days.
So the narrow claim is the honest one. A duration-neutral operation should not be expected to durably lower term premium, and so far it has not. That is our reading of the mechanism, and it is a reading rather than a settled fact.
It is also worth saying what the Treasury did not announce, because a good deal got attributed to it. No yield target, no quantitative easing, no yield curve control, and no abandonment of duration neutrality.
And there is a history here worth one line. Japan tried the harder version. Its government actually cut the supply of very long-dated bonds, including 40-year issuance. That is a more direct intervention than buybacks, reducing duration supply at the source rather than swapping it around.
Yields fell initially. The relief was not permanent. Reducing long-duration supply bought time. It did not resolve the underlying demand for compensation.
Now the part where we argue against ourselves, because an episode like this can very easily overclaim.
Artificial intelligence is an accelerant here. It is not the fire.
Go back to the Dallas Fed number. AI-related issuance is roughly 1/8 of the duration supply coming from Treasury issuance, which means government borrowing is around 8 times larger as a competitor for the same pool of investors.
And that government borrowing is growing quickly. Total U.S. public debt crossed $40 trillion in August 2026. The trillion before that took 95 days.
So if you want to explain why long-term interest rates are where they are, the fiscal deficit is much the larger part of the answer. Anyone telling you that AI capital spending broke the bond market is overstating it substantially.
What the evidence in this episode supports is narrower, and we think more useful. AI-related borrowing is a real, measurable, incremental source of duration supply, arriving at a moment when the market was already demanding more compensation to hold duration. It adds to the pressure. It did not create it.
And we should restate the limits on our own measurements. Option-adjusted spreads and new issue spreads over treasuries are not identical constructions. 2 dates are not a time series.
What makes us comfortable that something real is, there is the size of the gap. 5-to-1 against Meta's own rating band and roughly 10-to-1 against the broad market is far too large to be explained by measurement differences between two similar indices.
So let's close the circle, because every step of it is something we measured earlier in this episode.
Term premium rises, driven mostly by government borrowing, with corporate issuance adding to it. Step 1.
Long-dated corporate coupons rise along with it. For Meta, that was 37 of the 67.5 basis points. Step 2.
Step 3 connects back to the previous episode. When these financing structures are arranged, lenders size them against a debt service coverage ratio, how much cash the project generates relative to the payments it owes. The Meta-linked vehicle we looked at was arranged at roughly 1.12 times. That is a thin cushion, and critically, it is fixed at the moment the deal is done.
So when that debt eventually has to be refinanced into a higher interest rate curve, the payments go up while the cash flow does not. The cushion compresses toward 1.
Step 4. Weaker coverage is exactly what widens a credit spread. That is the other 30.5 basis points.
And Step 5 closes it. A higher all-in cost of borrowing on the balance sheet pushes companies further toward the off-balance sheet structures, which, as we found last episode, are themselves the more expensive instrument and come with no recourse back to the parent company.
That leaves what we would actually watch from here. Not predictions, specific things you can check with dates.
First, the 9th of September 2026, when the larger Treasury buybacks begin. If term premium falls and stays down, then a duration-neutral operation is doing more than its design suggests, and the mechanism we have described is weaker than we think. If it does not move, the mechanism is intact.
Second, the next large AI-related investment-grade bond deal. Watch what it prices at relative to the index, the way we did with Meta. Widening again means the loop is still running. Converging back toward the index means it is easing.
And third, the quiet one. whether financial issuance comes back. That is channel 3 running in reverse, and almost nobody will report it as news. It would show up as the corporate bond market absorbing duration more comfortably than the headline issuance numbers suggest.
None of those require a forecast from us. They are events with dates, and you can score them yourself.
Which is the point of this whole series, really. The circularity people talk about in artificial intelligence is usually a chip company investing in its own customers. The circle diagram everybody has seen.
We would suggest the circularity that actually matters is this one. The escape route from an expensive balance sheet is itself the more expensive instrument, and it gets more expensive as the curve rises.
Thanks for following the money with us. Education, not advice. And we will see you next time.
That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.